Hey, good day, everybody. It's Finance 3303, Financial Markets and Institutions, UNO. And we're on Chapter 7 in an area called the money markets or debt markets. And so Chapter 6 was money markets. That's posted to my YouTube channel. This is Chapter 7, bond markets. And guys, just we're going to take this at a high level because I think you've gone through some bond training in your time at UNO. You probably had it for 3,300. You probably had it if you took me for 2,302. And it's bond markets are a debt market. So just to take this as a high level, I'm going to go through these pages. And what I'm saying here on the video, those are the things that I would find important. You'll see me skipping things and you'll see me emphasize things. So the emphasis is obviously what I would want us to understand from a not just an academic standpoint, from a reality standpoint, because I'm coming from many years in banking. And what we're going to have in chapter 8 and 9 is going to be a little bit more focused. So, but we have to make sure we're starting from the same page. So here we are in bond markets. Okay, so just background on bonds. Bonds are borrowing. Okay, whoever's issuing the bonds is borrowing money, and any number of entities can borrow money. You and I can borrow money, but we normally wouldn't go through this process to do so. You would go to a retail bank and borrow money on a house, a loan, a car, credit card, whatever you want to borrow. What separates us from a larger entity like a Google or an Apple or a General Motors is they want to borrow a lot of money. And they do that by borrowing from the general public. So they're issuing bonds to the general public through secondary markets and through your brokerage account. So that's the way you and I can loan Ford Motor Company money indirectly is through what's called bearer bonds, and they sit in what's called a street name in your brokerage account. So you go out and buy one. The bond comes in as an investment to your account. It sits there in what's called a bearer form, meaning there's nobody's name on it. If you had a registered bond, that would be registered to the purchaser, like you and me. And we don't go through that because you want it to be in a generic form, because when you want to sell it or when it gets matured or redeemed, you want it in that bearer form so that it can be transferred to the next owner. And you don't want it registered to you. Savings bonds are like that. They register the savings bonds to the person that purchased it. It's a very, kind of old school thing. So while you're seeing these two words in bold, that's what they're wanting to say here. And so that's not so important, but I thought just to mention that it's not all the time that we hear, something in a bearer form, but that's really what it is. And that wouldn't be bad for us to know. Okay, so all right. Institutional participation in bond markets. So guys, a number of entities, like I'd said just a second ago, a number of them borrow money and they do that through the bond market. You got the US Treasury that issues bonds all the time, and that's what is comprised of US debt. Federal agencies like Fannie Mae and Freddie Mac and Sallie Mae and Ginnie Mae, all those are federal agencies of the federal government of the United States. They do their work with fixed income securities in the debt markets, which are bonds. Municipalities, who would that be? City of New Orleans, state of Louisiana. There are some police districts, school districts that issue their own bonds. Just any entity in municipal form. They don't have, now keep in mind, US Treasury they have no default risk here because the Treasury has a printing press. Nobody else does. So when you get down to a municipality, you've got default risk in there. Certainly when you get down to a corporation, you've got default risk in there. Not so much federal agencies, anything that has to do with federal. Again, they have the printing press to back them up. No one else does. So we can go bankrupt. The municipality can go bankrupt. The corporation can go bankrupt. And that would interrupt our bond ownership because we wouldn't get paid back. But these are all the entities that would issue marketable securities to who? Households and institutional investors would be the bond buyer. And I'll just leave that up to capture this graph in the recording because you don't have to. I mean, this is just kind of general information. And I'm thinking we're pretty straight on that already. All right, I'll just leave that up. Nothing there, not to worry about it. I'll just have it in the recording. All right, so what's in it for us? Guys, you would loan money to Ford Motor Company or Google because Ford's going to pay your interest. So if you bought the bond when it was first coming out at the par value of the face amount at $1,000, you would have a certain coupon rate, and that's what's going to determine your semi-annual coupons. But as soon as it comes out of the printing press, the bond's price is going to fluctuate like a stock price. Not as much as a stock, but fluctuate it will as just it moves through the markets. And as market information would be digested, just like a stock would. So it's going to become yield to maturity is probably the phrase that's going to sum up best our relationship with that bond, either as you're owning it or if you're planning on owning it. And from an issuer's perspective, they're just worried about, they have the $1,000 par value, and if the company says, okay, we're going to pay 8% on this bond, well, they're going to pay $80 per year interest to whoever holds the bond. So that's from the issuer's perspective, and then they're going to pay the $1,000 back when the bond matures. That might be, 10 years from now, might be 20, 30, 40, 50 years from now, depending. Ford not long ago issued 100-year bonds. So that, they're going to borrow the money for a long term. They're going to pay off the principal when the bond matures. But in the meantime, from the issuer, they're just paying, the $80 a year for every bond, given the circumstance that I painted here. It's consistent with their example that they're doing here. But when the bond price starts to move, that yield to maturity is what's going to be kind of the driving force for who buys it. You're going to be buying something with a decent yield to maturity because that calculation is taking in all of the coupons that you're going to get annually, plus the redemption amount. You're going to get 1,000 at the end. But what did you buy it for at the beginning? Did you buy it for $900? And you're going to make a little money on it. If you bought it for $1,100, which is the price that the bond could show, you're going to lose a little money on it at redemption. So how do you account for these things? Well, it would be a calculation called yield to maturity. And that's probably what would matter most to people looking for fixed income securities, namely in the bond market. All right. All right. Treasury and federal agency bonds. Okay, guys, all we want to mention about here is the Treasury auctions. They go to auction every week for like T-bills. And what they're doing at the auction is paying off bills that are coming due on that day, or bonds or notes. And then they're also issuing fresh debt because the US, like most governments, are constantly borrowing and increasing the debt level. That's another story. But that, you go to bond auctions, not you and me, but like big companies do, big banks do, treasuries for other countries do. So those auctions are held at the highest level because it's the federal government of the United States. Trading treasury bonds, so it comes in three forms, guys. Let me make sure I'm saying these because it'd probably be worth saying. So it's bonds, bills, and notes. Bonds, bills, and notes are all treasury debt. And they differ a little bit between them. If you took my 2302 class, we spent a little bit more time on this, but that's not really what we're trying to do here. We're just saying that through these instruments, the Treasury of the United States is borrowing money. And it's, they pay a coupon like everybody else and it matures like everybody else, but it's a debt of the federal government of the United States. So you have an active market from a treasury standpoint or a trading standpoint. They have dealers on these and they have books of business on these, and that's where the trading comes in. But it's not so much fancier than anybody else. It's just this book is saying that there's trading here. Well, no kidding. All right, online trading, that's what you and I would do. All right, I could say a couple of words on this. Strip treasury. So guys, just to refresh our memory, if you had a bond for a crude picture here. And this would be the bond's principal over here. It would say the $1,000, and it would say the par value is the 1,000, and it would say 8% would be the coupon rate, and it would say like 30 years would be the term. And then over here, you would have the coupons. Okay, so you would get paid interest every 6 months by peeling off one of these coupons. All of that's done for us by your brokerage firm. It's not like when my parents were possibly buying bonds, that was all by hand. But now it's, we don't have to worry about any of that. But anyway, when we say stripped, somebody figured out years ago that you could cut the principal away from, you're going to separate this away from the coupons. And that's called stripping. And when we're stripping the principal away, well, you can sell the coupons individually and you could sell the principal individually. And they're called strips. And by definition, a stripped principal is going to be sold for the present value of the $1,000 back 30 years. So, a stripped principal might be selling for $100 and it pays no coupons because those have been stripped off and sold. So this $100 is going to eventually turn into $1,000. How long is that going to take? It's going to take the 30 years. But a person wanting to buy them at the front end when it's been stripped and just wait till maturity, wait till the 30 years, there's your what's called accretion. This $100 purchase price is going to turn to $1,000. And again, you're not going to get the semi-annual coupons because those have been stripped away. So these are a big business. I mean, people buy, think about it for yourself. If you wanted to open up an IRA or something like that, then buy $100 worth of zero coupon. And 30 years from now, you all are college students. So let's say you start this when you're 30 years old. When you're 60 years old and ready to retire, all these things start coming due. So, I mean, you could buy one of these every month for $100 and you'd have $1,000 every month coming due, 30 years from now, and you bought it for a very little amount on the front end. It's a long-term strategy, but that's where, people got it, and do it through your IRA. Open up an IRA and you could buy, one of these every periodically, and buying strips there is a strategy to that. There is a plus to that. Okay, so not going too deeply into this, but that's what a strip is. We're wanting to remind us in case we've forgotten. I'm not worried about inflation index. Guys, these are savings bonds. I'm just going to spend a second on that. But these Series EE savings bonds, you're seeing them here. People, used to buy them when I was a kid. Everybody's grandmother used to buy them a savings bond when they were born, and for as little as $25. And that was very progressive. It's like every little mom and pop is taking advantage of savings for their kids, and they buy it. I know it's long term, but it's savings bond has a 30-year maturity. Do not have any secondary market because they're registered bonds. They're put in your name. You keep them at your house, or somebody does for you, and they're not tradable as a secondary market. You go in and you trade, redeem them. Usually at banks, commercial banks will redeem savings bonds, but that's getting less and less. I mean, you just don't see that stuff anymore. But that's a debt instrument. How people could loan money to the government and have some money there for their kids when they're going to school or whatever it would be. All right, as discussed before, federal agency bonds, Federal National Mortgage Association, or the Fannie Mae, or the Freddie Mac, or the Ginnie Mae. We're going to cover that a little bit more in chapter 9 when we get into mortgages. So that's going to be far more important, but we need to plant the seed right now. Guys, federal agencies, I have a whole nother federal agency securities on my YouTube channel. It's for another course, but you would benefit yourself. You need to know a little bit more about these. You can go to that other YouTube and go to that other video on YouTube and play that, and it'll explain a little bit further here. But let me say it very quickly. So, as these federal agencies were set up by the federal government, and really to create liquidity for the market and to take interest rate risk off of bank balance sheets. All right, so a bank is going, I'm just going to say a B for bank. A bank is going to make a couple of $100,000 of mortgage loans today, or let's say a couple of million. It's going to loan out to some people that want to buy a house, and that's fine. And the bank is stuck with that loan for 30 years. So really, that's uncomfortable. Banks don't like to loan money for that amount of time. So what they could do is the bank could sell the loan to Fannie Mae, okay, which is a government agency. Okay, I'm just going to put an F there for Fannie Mae. So now the bank has gotten rid of the interest rate risk. They sell the loan to Fannie Mae, and Fannie Mae gives them the money back so they can make a loan the next day. Fannie Mae doesn't want the loan. So what they'll do is they'll package them into bonds. Yes, bonds, and sell those bonds to who? Mutual funds, to people like you and me, to sell to investors. I'm going to just say an I there. And then the investor gives Fannie Mae the money back. So what we have here is a circular diagram of how these loans are turned into bonds. And when we go into chapter 9 on mortgages, that's going to be kind of the highlight in this course of how this process works and why it works like it does and why is it so popular. So you and I could be buying, people's mortgage debt, and Fannie Mae will stand behind it. If somebody doesn't pay their loan back here, Fannie Mae will pay off the investor for them. And that's where, it gives some strength to the mortgage market, because you and I could invest in these without worry about default. Okay. Because investors fear that they might default. So you got that in the paragraph here. So that's where the federal agency would come in and backstop that. So you and I we're not worried about it. So that's where mutual funds feel like, well, I can invest in these things very easily and contribute to this circular process. And it keeps banks making mortgage loans, because otherwise we would say, well, I'm going to make a couple of them and I'm going to shut it down because I can't make an infinite number of mortgage loans. I don't want the interest rate risk on my balance sheet. So that's, from a financial institution standpoint, federal agencies step in. It's a big deal to have them in the marketplace. So more about that as we're going along. But I wanted to make sure we're understanding that, even at the high level that we are. Okay, municipal bonds. Guys, they come in these general obligation or revenue bond. I'm not worried about that. Neither should you in this course. We could go much deeper, but that's not the point of this. So this is just the state of Louisiana or the city of New Orleans. Those are municipalities. They can borrow money. Okay, they don't sell stock. You can't buy stock in the city of New Orleans, the state of Louisiana. But it's popular. The municipal bond market is a big market, because the governments within those municipalities, they finance, bridges, and the state of Louisiana could borrow money to finance, the school system, the universities, and so on. So a lot of that goes into the municipal bond market. And again, you and I could be lending money to the state of Louisiana, and they're using that money for roads, they're using it for bridges, they're using it for education institute, they're using it for anything that the state would have to use money for. But just be reminded that there's credit risk. Okay, they could go into Chapter 9 bankruptcy, and you could have problems on your bonds. And the municipal bonds, they have rarely defaulted, but they have defaulted. You could look that up on you Google it, and you'll see, well, there's been several in California. Actually, I think Illinois did it at one point, and I know New York went into default on a bond issue many years ago. They borrowed too much money, like any other entity. So we just have to remember that. Okay, the ratings, like any other bond, they'll have municipal ratings that tell you which state is in better shape than others financially. So we don't have to worry about that very much. Variable rate munis, like any variable rate bonds, guys, you wouldn't have a fixed coupon. You would have a variable rate, and then they would index that to something on the outside. It would be like the, Wall Street Journal Prime, or they would be like the Fed funds rate or something like that, a rate that can move over time. So you could have that. The majority of any bond is fixed rate. but you could have variable rate. That's going to go a little bit further. I'll pause here and just mention that because when we get into bank management, what's going to come in to play is when cash is delivered and when your coupons are delivered, and it's a timing thing. So that's going to play into the next couple of chapters. That's why I spend a second on here. And if we're worried about interest rate risk, if you're a financial institution or you're working for one, if you're worried about interest rate risk, you might issue a lot of variable rate securities, like variable rate mortgages. We've loaned at my work, we've loaned people, not many take you up on that because people like a fixed rate, a fixed payment, and they can't handle my payment changing periodically. So people don't like that, but some people do. Some people are thinking, well, I think rates are going to go down and I'm going to benefit by it. So I'll do a mortgage loan with a variable rate on it. There is some tax advantages to munis. We don't have to worry about that. And of course, they're traded on public exchanges. All right, yields offered on municipal bonds. There's a graph. Okay, so the majority are the corporate bonds naturally. That's what we are probably learning the most of. Let me pause this recording. I'm going to pause. Hey guys, I'm back. I just had to make a phone call. Phone was ringing. Okay, so the corporate bonds, as it just like we described a little bit ago, that's the ones that we learn most about. So par value is $1,000. Typically, 10 to 30 years is the term. Boeing, Chevron, and other corporations have issued 50-year bonds. Like I told you, Ford issued 100-year bonds. Coke had issued 100-year bonds. That's rare, but they do it. So they're just borrowing money for a long time. And it's usually institutions, mutual funds that will invest in these things because of their term. You and I are probably not going to buy a 100-year bond. It just doesn't make so much sense to us. But the company is a perpetual entity, and they don't mind issuing debt for 100 years. And guys, that's where they'll put some things in their bond indenture, where that's the phraseology and that's the legal words when we say it's an indenture. That's where they'll say the bonds are either callable or we can pay them off early or the rate can float. And the corporation tries to protect themselves in that way because it's such a long term, even for a corporation that's going to survive over time, or that's the idea. To borrow money for 100 years, it's hard to look out that far and say, well, what are interest rates going to be 10 years from now, much less 100 years from now, and you're stuck paying that semi-annual coupon at that coupon rate for a century. So usually they'll put some qualifiers in there to keep them a little bit more liquid and to keep that process going. But this is the one, guys, we're learning about this most in a university class, corporate bonds. But I'll say this, that for instance, in financial institutions, banks can't buy corporate bonds. You go to jail for that. So that's where the municipals come in and the federal agency securities come in and the treasuries come in. That if you were, for instance, investing in the investment department in a bank, you're going to have a lot of those things and you're going to get used to those markets more than the corporate bond market because that's what your job is. It's going to be investing in, try to maximize the yield to the bank. And if you could do it by agency securities or you could do it by municipal securities, there would be rules around those, but you can invest in those. You can't loan money to AT&T if you're in banking. So, it's kind of, I think the majority of us, myself included, who gravitate towards corporate bonds is they would pay more than the others. And we would be, if you're interested in bonds at all, you find yourself going through corporate bond listings and for individual investing. But keep in mind that you're all finance major, majority of finance majors, where you're going to be working, what you would have to know if you're choosing to work in those fields. All right. So public offerings, like I mentioned before about the Securities and Exchange Commission and all the things that are involved in a corporation borrowing money. It's a bigger deal. Of course, it's bigger dollars. So that's why it's not like they go down to the Whitney and try to borrow $100 million. That's not going to go very far. They go to investment banks, which have that process that they could get the bond offering to the general public. So you and I could see it. We could trade it on exchanges, and that's what would keep that process going. All right, some Wall Street Journal tracking bond benchmarks. There's not much to add here. You could just see those. I'll just let it be part of the recording there. All right. Guys, a private placement, I could mention that here as far as an underwriting process, because I saw it recently and I can't remember which company was doing that, but one company was borrowing like $100 million, and it was a private placement. In other words, it wasn't going to the secondary market where you and I would see it. It could go to, Warren Buffett has done that for corporations. If you know who he is, you should. But a very famous investor and a very wealthy individual. But sometimes he'll go to, like, he did that through the credit crisis. He loaned Bank America $5 billion out of his own monies, out of Berkshire Hathaway, the company that he owns. And it was a private placement. In other words, they created, it was preferred stocks. They created a listing of preferred stocks and sold the whole thing to him. So as long as he didn't trade it, you and I couldn't really see it on exchanges because it was privately placed to his company, and it made sense for him to do that at that time. He loaned them the money, and instead of just providing a loan, he asked Bank America to do an issue of preferred stock, and that way, whenever Warren wanted to get out of the issue, he wouldn't have to think about it. He wouldn't have to go back to Bank America saying, look, I want you to pay your loan off. No, he would just sell those preferred stock into the secondary market, and that would be some way for him to offload that investment to the general public. But it was at first sent to just him. So it was kind of an interesting thing. That was all going on in the tussle of the credit crisis back in 2008, 2009, where everything was the market was a mess, and that's how some companies got around a very tight market, meaning that people weren't trusting of other financial institutions because it was a crisis of credit, and you didn't know who was debt worthy. Well, Warren Buffett could physically go over, he and his team could go to a place like Bank America, and they could sit down and hammer out a deal, and it was very very focused because, again, he was the private placement source where he could cut a check back to the company and buy all of those fixed income. Again, it came in the form of preferred stock. But what was Warren worried about? Bank America needed the money at the time, and Warren was worried about the credit risk. He was worried about getting paid back. So that was all part of that discussion. Okay, bond ratings is, guys, we looked at credit ratings for people, there are credit ratings for corporations, and that determines what their ability to pay back is. So if we're pulling a credit report on a person and they have C or D or E credit, well, you know that they don't handle their bills very well, or something has happened at some point in their past for them to get a low credit rating. So for companies, if they messed up on some things, or their financials are very weak, they're not earning a lot of money, they would be issued what's called junk bonds. And that's just corporate bonds that have very low credit ratings. So the probability of default is high over what's called an investment grade bond. Those are, the better companies. That's a Walmart, a AT&T, a Google, a junk bond right now is like Ford Motor Credit. They're double B credit rating, which isn't good. So they mention right here, during the credit crisis of 08, 09, they had high risk premiums because, again, people were worried about what the market was going to bring. And this is what you saw. You saw that, in high yield debt, they went up to like 16%. And look what the triple B, that's an investment grade, and look for double A. Those are very stable markets, and the high yield market was very volatile because the company's financials were risky to start out, much less inside of a crisis. All right, the secondary market for corporate bonds, that's just when you and I are trading bonds, guys. So it's very liquid. There's tons of inventory out there. If you ever saw inventory, maybe we could see that in class. I could show you what that looks like. But that's what you would do in case of your brokerage account. You'd log on like you would normally do and go to their fixed income page, and you would see if it's Fidelity, if Charles Schwab, Merrill Lynch, whoever, those brokerage companies, you would see what their inventory is and you would see what they can get. So if you wanted to buy something that, is on that list, it would be very generous. They would have quite an access to that. The big substantial firms would, and there's no shortage of corporate bonds out there. That's for sure. This it says liquidity in the secondary market, so that's what they're talking about. All right, so that would just be through like a market order. Since they say in it here, I'll go ahead and mention it. Types of orders through a broker. That market order would just buy it at the current market price, and whatever you're seeing in front of you. In a limit order, you would say, well, no, I don't want to buy that bond at $1,000. I want to buy it at 950 if it ever goes down to 950. Problem is, it may never go down to 950, and you'd never be able to own that because you've set a limit order. But not going into trading here. But those are kind of the high level things that we usually talk about if we're mentioning a bond trade. And what I alluded to before, guys, the indenture, that's where it's a legal document specifying the rights and obligations of the issuing firm and the bondholder. So, it's normally several hundred pages. So that gets a little bit tedious to read an indenture. I don't know if I've known anybody ever to read the entire indenture, but it's the top line things are usually pointed out when you go to buy that bond. Is it callable or not callable? Or is it like a variable rate coupon, or is it a fixed rate coupon? Those are usually the things that'll come out to you first. And on the inventory through your broker, they would say those things, not what the money is used for and all these things. So that goes into an indenture. It just gets very involved. When you get the lawyers onto something, it gets very involved and very, very lengthy. All right. Guys, you could have what's called a protective covenant issued in like an indenture, and it would be something like, if the company's, it would be protection for the bondholder. I'll just make one up. If like the company's debt rating ever fell below investment grade, the company would owe you more money. That would be a protective covenant for you and me. Because you're buying the bond right now, the company is rated single A, everything is fine. 10 years go by and the company is weaker, and then they fall down below triple B, they go into double B. So it might be that, the coupon rate increases by a percent or two to the bondholder because that's only fair. You're taking on more risk and maybe the company has to pay up for that. So that would be a protective covenant. I'll leave this here and it's captured in the recording. Call provisions I alluded to just a little bit ago. That's when the company could pay off the bond before it matures, and that would also be in the indenture. Sometimes they offer a call premium, which would be like they'll give you an extra coupon payment or something if the bond is being called ahead of time. That would have to be in the indenture. All that has to be written down, guys. Any of this has to be in the indenture. Going further down here, the bond collateral. If you're looking at bonds that are secured by property of the corporation, well, okay, it's got to say that this is very specific. The company's headquarters building, it's got other assets and real estate, and this is backing this bond issue. A lot of bond issues come out very generically, and it's just like, well, it's just, the company is raising money. We're using it to do a number of things, and we're going to build other properties and everything, but the property isn't, it's covered in the indenture in a very blanket way. It's just like, all of the property that the company owns is attached to its debt. So that it wouldn't be very specific. So you could have that. Again, that's when an indenture gets very lengthy, describing all of those things that could be in a bond issue. Okay, we talked about zero coupon. We talked about variable rate. Not worried about convertibility. how corporate bonds finance a restructuring. So, guys, y'all know about anybody that's in New Orleans knows what Popeye's chicken is. The guy Al Copeland, he's deceased now, but they went bankrupt. He ran Popeyes into bankruptcy. It was a very well-performing company. It was a private company. It was just his company, and he was making a mint. And he says, I want to be, literally, he said to everybody, I want to be the chicken king of the country. So he went after Church's Chicken. I don't think they exist anymore, but he's like, I want to buy the entire Church's Chicken, and then that'll be part of my restaurants with Popeyes. And Church's Chicken kind of was like a sub. It wasn't a good quality. It wasn't like a Kentucky Fried Chicken. We know Cane's now. We know Chick-fil-A. Those are higher level. Church's was kind of a lesser level. So he floats a bond issue, borrows money by issuing bonds, takes the money and buys Church's Chicken. Problem was, Church's and Popeyes weren't throwing off enough money. It's called a leverage buyout. You're seeing that right here. So it wasn't throwing enough money to pay for the bonds. So it was a default. So that's where Popeyes went to bankruptcy and brought the whole thing down. So you had a lot of people losing a lot of money, but that was what's called a buyout or structuring a debt structuring deal, where companies have gotten into that. Many companies have done that and have gone out of business because they couldn't afford the debt. They just borrowed too much money. It was that simple. Using bonds to revise the capital structure. Guys, you could have bonds, a company would borrow money by issuing bonds to buy in some of their stock. Okay, so it's a debt for equity swap. You're seeing that here. And what they're doing is just trying to rebalance. Now, this would be, if you remember back in 3300, the weighted average cost of capital. And you had a formula that was calculating how much the capital structure of the company is. And you were using common stock, preferred stock, and bonds. So you can swap between them. Okay, then the company could say, I'm issuing stock to pay off some of my bonds. So you could have it going each way. And what the company is doing is kind of restructuring their capital. And it's usually for a benefit to the company naturally. But maybe, interest rates have changed and things have moved around that they could do that for the financial benefit of the firm. But that's what that is. Okay, so you have globalization of bond markets. So it's just like anything else. I mean, debt markets are global. You have other countries. The U.S. is borrowing money by selling bonds. So you could have, Brazil doing the same thing, or Italy, or whatever. So you could buy Italian bonds. You could buy Japanese bonds. All this, and it's just a global debt market where if you wanted to invest in those things, you really would have to understand something about the country, or just get it through a mutual fund and let somebody else worry about it. But we're not going to go deeply into that. But I just want to make sure we understand that debt is all over the world and it's traded very actively. So with that, I'm going to call a stop to this chapter and to the recording. And I think that's fine. This perfect. A perfect place to stop. Okay, guys, thanks for listening.